Hi there, everyone, and welcome to our first edition of On Track for 2021. Happy New Year. Hope everyone had a great Christmas, holiday period, and hopefully good things happening in your world. So it's the 28th of January as I record this. So the numbers in this are for the end of December. And I just thought I'd had a few questions about the timing of when we release this month. So I just thought I'd start off with sort of explaining that. So the GPS Investment Committee meets on the third Thursday or Friday of each month. So I tend to wait till after that's there. Now, the reason we meet on the third Thursday or Friday is data from all the investments we invest in is updated by about the middle of the month. So the numbers I talk about here are the returns to the end of the previous month, in this case today, the end of December. But it is important. I talk about the news right up to the minute. So the news for that month, but also for whatever's going on. So yeah, welcome to this edition and the first one for 21. Let's hope 21's a good year. It's certainly going to be an interesting year. As always, general advice warning. This presentation is designed for clients of McGregor Wealth Management and especially those that use the care investment process. For those of you that aren't clients, you're welcome to watch this. Hope you get something out of it. Please seek advice before acting on anything we talk about in these sessions. So I'm going to cover today some sort of economic updates, market where it's at today, where we think it is, updates on the key sectors of the market that are in your portfolios. We're going to look at the portfolio returns. We're going to talk about 2020 and gaze ahead and see what might lie ahead. And as always, help put the news into perspective. So let's have a look at the news highlights firstly. And we saw last week the Biden administration, Joe Biden inaugurated the administration takeover. We've seen the key posts there, and in most cases, very good people. So an early sign for Biden is he's appointing highly qualified people for his key roles, Secretary of State, Secretary of Treasury, these types of things. So he's indicating he's going to be a president that seeks the advice of good people rather than one who wants to, let's say, be a bit more dictatorial. I think that's a good thing. The markets, since the election, have responded well. So the market likes the fact that Biden's coming in. There'll be always some lingering doubt amongst some whenever you've got a left side of politics in power, whether they spend too much. But what the market wants to see at the moment is actually plenty of spending because the economy is so weak. We saw lots more lockdowns in the lead up to Christmas and after Christmas, particularly in Europe, as they went through chronic waves. We saw it in England, Ireland, Europe, where just rampant COVID cases. So that led to new lockdowns. That resulted in a slowdown. So COVID cases were starting to decline. That's the new cases in Europe. That's a good thing. And at the same time, we saw vaccines starting to roll out. So in some countries, I think Israel's got the highest percentage vaccinated so far at 28%, UK about 10%. That's a percentage of their population. Australia yet to start, but starting very soon. There's predictions that many countries in the world will get to about 70, 80% of their populations vaccinated in potentially the third quarter of this year. That's August, September. That's going to be a critical time. So the key factor there is, when do we reach herd immunity? And that's the point where most people aren't going to spread COVID. And the critical point there is not so much that most people aren't going to spread it, that we stop thinking about it all the time. At the moment, you can't have a conversation. You can't sit down with anyone and not talk about COVID. So COVID dominates everything, from your conversations to economics to predicting different outcomes for different companies. So it actually dominates everything. There will be a point in the future where it doesn't. All these things pass eventually, and that's one of the $1 trillion questions. I'll talk about another one in a minute, but yeah, that is when do we have herd immunity? When do we stop worrying about it? When can we travel and be allowed to leave the country when we feel like it, and come back into the country without hotel quarantine? That will be, to me, the sign that the world is back to its regular place. The US profit season reporting's underway. We've seen some fairly good results, a few disappointments as always. That'll lead to a bit of market volatility in the next couple of weeks as that comes out. But the market had such a good run off the back of that November Trump being evicted, Biden coming in, and also off the back of vaccines rolling out. So we had an amazing November, a solid December, and we may see sideways for a while. We may even see a few little bits of declines, waiting for that next batch of good, fresh news, which will probably be about the path towards herd immunity and the path back to normal. We've seen some strong economic data in Australia, and I've got two charts there. Down the bottom here, the chart on the left shows the time in recessions that it takes to get employment back to where it was. So, and you'll see the 91 and the 1981 and the 1990 recessions. It can take a long time to get employment back to normal. In Australia, we've seen employment firing back up rapidly. It's been quite a surprise, and it's quite pleasing to watch because economic damage to the community really comes from high unemployment. So we'll see how that continues, but relatively good news and relatively surprising how quickly employment is coming back there. And the one on the right is retail sales. So this is how much you and I all spend. And we saw during COVID, firstly, we saw a spike. That was the panic buying. So everyone bought all their stuff quickly as we started to go into lockdown. Then there was a complete collapse for that first 6 weeks of lockdown when most of the country couldn't do anything. And then there was a rampant spring back. And retail sales is actually above its long-term trend. What that tells you is we're spending money. So consumers are out there spending money. They're spending it in different areas while they're not traveling. They're going to Bunnings, they're doing home renovations, they're doing makeovers of gardens, they're buying caravans, boats, cars. The prices of secondhand motor vehicles, motorbikes, boats, caravans are all holding and going up in some cases, which is surprising. And that's because there's a bit of a shortage of equipment coming into the country, just with trade down because of the COVID sort of restrictions. So yeah, some good news there. And I just thought I'd highlight that the numbers on the right there still emphasize what we've been talking about. Interest rates super low. You get nothing for your cash. If you're willing to lock your money away for 10 years with the Australian government, you'll get 1% per annum. Not much of a return for locking your money away for 10 years. It's certainly not something we'd encourage unless you were completely fearful of what might happen to the rest of the world, which we're not. Aussie dollar up a little bit, so it's been strong. I'm going to talk about it some more during this. A little sign of inflation, but keep in mind, inflation under 1%, likely to stay that way. We've got inflation targets normally of 2 to 3%. The Reserve Bank would normally try and keep inflation in that band. They've actually stated that they're not going to lift interest rates until inflation is well into that band. We'll see if they stick to that. And that's that $1 trillion question I list here. When does inflation appear and when will interest rates go up? If you can predict that, you can be the next $1 trillion hedge fund manager, because that will drive a lot of key things in financial markets, which I'm going to talk about as we go through. So let me just reinforce. Firstly, the care portfolio returns, quite pleasing when we look at the longer term. So 5-year returns are pretty much slightly ahead of what we would expect when we're planning your future. So the purpose of an investment portfolio is quite simple. It's to meet your future plans. So you'll hear us talk about these targets when we calculate your future returns: inflation plus 2%, 3%, 4%, 5%, etc. And for the 5-year numbers at the moment, they're tracking at that. Inflation over the last 5 years, probably around 2%. So if you take 2% off there, you'll see those 5-year numbers ahead of the target. 3-year numbers close to the target. 3-year inflation, probably about high ones. Take that off, almost bang on. Targets, 1 year, of course, is a negative. So if you look at the returns, and if you can see my cursor on the screen, we've got an inverted return table for 1 year. That means more conservative investors did better than aggressive investors. So if you're in the share market, you did worse than everyone else. That happens about 1 in every 6 or 7 years, but it's not the normal. So that should never justify that strategy ongoing. 1 year returns can vary dramatically. And ironically, you'll see in the 6-month columns here, good returns. I'm going to talk more about the active portfolio. It's had a spectacular year and spectacular relative to sort of zero returns, but it was up 7.2% for the year. And I'll talk about why and how that kind of works. And it's done 11% over the last 5 years. So a very important part of the portfolios. So as always, my aim is to put into context. You'll hear us talk about this framework, how the market goes through most of the time the wall of worry. It wobbles up the hill, but we're always worried about another crash, another GFC, another tech wreck, another pandemic we'll talk about for the next 10 years. So the market will be forever worrying about that while it quietly creeps up. Occasionally, a market will emerge into boom territory, or FOMO, fear of missing out, where the market goes crazy up. And you can see it in these long-term charts. They only happen about every 15 to 20 years. They're not predictable. They sneak up slowly. They're usually justified by most people. As this time it's different. The tech boom, for instance, this time it's different. Technology is changing the world. And yes, technology does change the world, but ultimately companies need to be profitable. So the booms are always followed by a bust. And busts are always follow a boom, except for a pandemic. So we had a bit of a bust this year in 2020 that was not caused by an economic boom or not caused by FOMO. And that makes it very unusual, certainly in the last 100 years. But that's partly why it's bounced back quickly as well. So our framework has held us well there. So each month, we, the investment committee, attempt to put one of these labels on where the market's at. And I'll talk about that. That represents the psychology and the swing of the market. And we do have the market at just above fair value at the moment. We don't pretend that tells us what's going to happen next. If we knew that, we would be trillion-dollar hedge fund managers. And no one actually knows to tell you what's going to happen next year, next month. We do know in the long run, human nature, which is mostly positive, pushes capitalism, which pushes markets up. But during that time, the psychology swings between fear and greed, or fear and FOMO, which is fear of missing out. At the moment, we think those things are fairly well balanced. The 2020 year we've just been through, where the market dropped 36%, puts that at the fifth worst downturn in Australia in the last 120 years. So it was a big one. So congratulations, you've survived one of the big ones, and the portfolios have generally held up well. And that's through a very carefully thought out investment strategy and a methodology we've been using for nearly 20 years now that rests on planning as the basis for all decisions, really understanding history and cycles. Once we then can, part of the reasons we communicate regularly to you, our clients, is to help you put everything in context and help you avoid making bad decisions, particularly in a crisis. The biggest dangers are in the boom and bust periods. And if we can avoid making bad decisions in those times, we will survive and prosper. And then we can get down to the things that we know make the long-term returns tick over. And that's a good asset allocation that's appropriate to your long-term plan, massive diversification, so no one investment can ever knock you out, and regular rebalancing, which is the quiet achiever that adds 0.5 to 1% return. I'm going to talk about that in a bit more detail today. And we're trying to avoid what most people do. And as the charts from numerous research shows, but this one on the top is from Delbar. Investors, which is the red bars, underperform investments because they don't just buy and hold. They zig and they zag. They get excited and gear up. They panic. And that means they enjoy generally less than half the returns that the investments get on aggregate. That means some will enjoy better, some worse. And the reasons they do that, we use this little acronym called MESS IT UP. Too much focus on the media, and the media is negative 90% of the time. The media had their best year ever in 2020. They had more to talk about, more to be negative about than I've ever seen. So they kept us glued on daily announcements from the politicians who also loved being in the spotlight. They got to be more powerful than they normally are, and people watch them day in, day out, waiting for the next announcement. When can we get out? When can we be free? So the media makes terrible long-term investment advisors. What they do is drive our emotions, and we're emotional creatures. We tend to get scared and excited, which exaggerates the emotions of the markets. And part of that is these next two, the short-term focus and single issue obsession. We've had the biggest single issue obsession I've ever seen in my lifetime with COVID. Never before have I seen a year where every conversation has pretty much got COVID in it. Not all, but it's very hard if you're catching up with people to not talk about lockdowns and everything that comes with this. That's given us an incredibly short-term focus. That's going to cost a lot of people a lot of money. And in the long term, those that can stay focused on long-term goals and long-term quality portfolios will absolutely win in the long run. There are only three ways to lose money. One is if we have to sell at a bad time because we don't have enough liquidity. We call that illiquidity. And attempting to time the market. We saw this year active managers and hedge funds that are the ones that think they can time the markets actually perform well under the benchmarks. When we look at the comparative performance of different funds, the ones sitting at the top over the last few years are ones that are predominantly index. So the ones that are trying to time and trying to out-select are actually falling further behind. And as always, diversification, critically important. And a focus on short-term performance, especially, massively misguided. We've got to look at what makes up that performance and be able to see through it. So let's review 2020 and let's talk about, as we go through, I'm going to do that by going through each sector. So Aussie shares finished the year at plus 1.87%. Normally we're saying that was a pretty ordinary year, but considering at one point we were down 36%, it's a bit of a get out of jail. But yeah, and better than cash, by the way. So cash for the year would have paid less than 1%. So shares just managed to beat cash over that period of time. You'll see that big downturn. We had that in two phases. We had the first 20%, the Wuhan correction, and then as COVID rolled out to the rest of the world, we went down into pure fear. We talk about our cycle from FOMO to fear. At that point, it was about March 24th. We're in pure fear. Governments then came out with stimulus, and federal reserves and reserves banks came out with stimulus. That meant spending money to soak up. It meant subsidising wages, JobKeeper in Australia and other different forms around the world. That gave the market some relief that we weren't going to end in a horrible depression with soup kitchens and everyone else. And the market bounced back fairly quickly during April, still not back to anywhere near where it was, but it bounced out of fear. And then it was actually in cheap territory. We held there waiting for lockdowns to come out. Lockdowns initially came out. We saw that the world wasn't going to end and the market jumped up another level. But then it was waiting to see, how does this finish? How do we get out of this? We know we're stuck in a low growth world. We're surviving. And this is about June. Different lockdowns, different parts of the world. For most of the world, they were kind of free, but not able to do more broader travel. The market went sideways for a while. And then in November, which two important things happened, a change of power in the US and the rollout, or not the rollout, but the announcement that we had firstly 1, then 2, then 3, then more vaccines that were going to be available to roll out. That caused the market to jump radically. And now we're bouncing along, going sideways, effectively waiting to see how effective the vaccines. So the key drivers going forward that we think about and we're focused on as an investment committee, obviously economic growth drives long-term share prices. In a growing economy, companies have the chance to make profits. So it provides the basis for good growth. So we're watching growth. That growth will be driven by the two big ones, consumer spending and government spending. So during this crisis, governments around the world had to chip in and take over spending as consumers didn't, and particularly as corporates didn't as well. As corporates lost money, it was up to the government to step in. And it's classical Keynesian economics that only came about in the 40s. So this is economic policy responses that weren't really thought of as mainstream when we had the global depression in the 1930s. So governments reacted with spending, and that's what prompted the recovery, and that's what will continue to drive the recovery. And on the other side, we've got herd immunity, depending on how quickly that comes. And when we stop talking about COVID, to me, that's a key. And one of the key signs to watch is the recovery of what I've called damaged sectors. That's travel, tourism in some degrees, although local tourism in places like Australia is actually doing fairly well. There's some companies that aren't. Tours that rely on people interstate, that rely on people in buses or in close confinement. The airline industry is the most obvious one, completely trashed. And as it comes out, that will see the start of economic growth. Now, don't forget, share markets anticipate that growth. That's partly why we've seen markets recovered. So that I'll say it again, the market is not the economy and the economy is not the market. They're linked, but they move in different timing. The market moves in anticipation of economic growth. And often if that economic growth fails to materialize, that's when the market falls, and the market will sometimes fall when it starts to anticipate economic growth slowing. One of the things that slows economic growth in the long run is inflation and interest rates. So we're keenly, along with everyone in the financial sector, watching and trying to work out when interest rates might start to go up, because that will be the next thing that slows the economy down. It's nearly always the thing that puts economies into recession. And that's as a result of governments trying to slow down spending, slow down rampant growth. So they normally overreact and tip economies into recession. It's a long way off. So the consensus view is that interest rates and inflation will remain low for a long time, 3 to 5 years, potentially more. But as we start to see growth, that can change very quickly. So if inflation does start to appear, and if that's driven by wage rises, which will only be driven by low unemployment, and that's why the employment number is so important. But if we ended up with inflation coming in at some stage in the next few years, that will start to potentially sow the seeds for the next downturn. But it's something you shouldn't worry about now, because what happens before that, the only reason we would get to that case is if we're growing and booming. So in that scenario, that inflation comes sooner than we think, we'd actually have a boom before we had some sort of bust. So that gives us cause to remain solid with our investment process. If inflation takes longer, that will actually underwrite the share market staying fairly steady, because in the absence of any interest rates, the share market becomes somewhere that people almost have to invest in. If interest rates stay stuck at between 0 and 1%, anyone who wants to get a decent return will gravitate towards the share market. So we feel the share market has a bit of a floor under it from those factors. It doesn't mean it can't go down. It will go down periodically, as it always does, but it means it won't go down too much, because what we're going to see, if ever we get any weakness, and that's reflected partly by share market going down, we'll see this government response in spending, and eventually that will catch the economy on fire. We'll come out of this and we'll go through the normal economic cycles. But interest rates will rise eventually. No sign of it in the next 3 years, but whenever everyone agrees on everything, always worth watching out. But I think we're in a, we've called the Aussie share market just over fair value. But we're at 7,200 on the ASX 200 before COVID hits. Many people think we'll get there this year. I tend to agree, and that just puts us back. And that's because the market will be anticipating a pretty much full return to GDP growth as it was beforehand. So US shares, same but different. So, and I've shown two pictures here of US shares for last year. One is the picture we have in Australia. So the top chart here, which is VTS, which is in our core portfolios. You'll see that it's just getting back towards the pre-COVID levels, but the bottom chart shows US shares, so S&P 500, the same index, but with a US view. The difference is the Aussie dollar, which I'll explain, but US shares actually got back to their pre-COVID peak back in September, and they're well above the pre-COVID peak, causing some people to think it's a bit overvalued. Now, most of that drive has come from tech stocks, in particularly the big companies like Facebook, Google, Apple, Microsoft, Amazon, that have risen dramatically over that year. But why don't we see that in our performance in Australia? Well, that's because of the Aussie dollar. So you'll see this little chart in the middle. We saw during COVID, the Aussie dollar drop dramatically, but very quickly came back. And it was only a couple of months before it was back to pre-COVID levels, and now it's higher. So a couple of things: when the Aussie dollar, when the US dollar goes up, when the Aussie US goes up, say as it did from 60 to 70 cents, that means that diminishes the returns from overseas. So even though the US markets are up 10%, that's been cancelled out by the rise in Aussie dollar. Now, the rise in Aussie dollar has it has winners and losers all over the place, including some Australian companies. For companies like CSL and others that sell in US dollars, there's some benefits there. But so there's winners and there's losers from the rising US dollars, but we've seen that cramp our returns Now, if we see the Aussie dollar fall, we can mitigate. And it's something I've talked about with some of you. So what happened when COVID hit and share markets dropped? The Aussie dollar nearly always drops in a crisis. So what that means in a crisis is for that window when markets are going down, overseas shares for us in Australia actually outperform. So they actually become a bit of a downside hedge. It's not to say that's always going to happen, but it's been pretty consistent in the past in the big crashes that there are also times where the Aussie dollar falls. In the 2000, and you can see the long-term chart on the side here, but certainly in the 2007-8 GFC, as the share market fell 50%, the Aussie dollar dropped from $1 to 50 cents. So that completely cushioned the drop in overseas shares, but we did suffer from the drop in Australian shares. Once again, highlighting the importance of diversification. But long-term returns, rock solid, and you'll see the 10-year returns for US shares up around 17%. And 5-year about 14. We've got that at just over fair value. There's a lot of stories in the US market. We've got the tech story, but we've got old school companies that just do normal industrial stuff. So that some of those are very cheap. Some of the tech stuff's expensive. This is why we like owning the index, because we get to own all of those. US small caps, and I've thrown in down the bottom here. I went back to an old research paper done by some academics, Switzer and Picard, that showed that US small caps outperform US large caps over the long run. And the chart here shows that they've outperformed in the last 100 years between 1% and 5% on average. So that's why we have small caps in the portfolio. The reason we don't have more is that they're more volatile, and they actually underperform during every recession. So the recession are the grey bars here. So every time there's a recession, small caps actually fall more than large caps. And then as we come out of the recession, they rise stronger. So that gives us good optimism for small caps going forward. They did do it tougher. For instance, last year, just 1%. But we think small caps will resume that outperformance over the long run. You can never tell how quickly, how often, but we expect that to continue to be an important part of the portfolio. And it's delivered good long-term returns. Yeah, 5 years, 10%, yeah, which is up there with what we'd expect. And we expect long-term, we have an expectation that small caps would outperform large caps by about 2%. So let's have a look at global leaders. And these are all by definition large caps. So this is the top 100 companies in the world. And you can see here, so IOO, which is the company that we use, the exchange traded fund or the ETF we use to get into that, this is its holdings in the bottom left-hand corner. So we can see those companies I was talking about, Apple, Microsoft, Amazon, Alphabet, which is Google, and you see Samsung, a couple of old school companies, Johnson & Johnson, and JP Morgan, Procter & Gamble, Nestle, but dominated by the tech giants at the moment that now make up 50% of that large cap index. In the last year, we saw them perform at about 7.7%, so not too bad. They're also affected by the US dollar being stronger, by the Aussie dollar being stronger against the US. So that return would have been higher in their domestic countries, but still nonetheless a good result. And once again, long-term returns good. And we've got them at kind of fair to expensive, but there's a massive range of companies. While we think some of the techs might be a little bit expensive, and keep in mind, they can stay expensive for a long time. And they're all making lots of money at the moment as the world's gone towards online in terms of business and commerce and people online shopping, but doing business online. That's why the techs are up there. So then we look at emerging markets. And emerging markets, like small caps, they outperform large cap countries in the long run, but they're much more volatile as well. So we saw a volatile year, big drops from emerging markets, but we've seen a big comeback, particularly in the last 3 months. And that's partly as investors, professional investors, look and see some sectors of the US may be a bit overvalued. They're switching towards these emerging markets, which also tend to outperform during recovery. You'll see the makeup of the emerging market index, China, 40%, Korea, 13%, Taiwan, India, Brazil, South Africa, Russia, etc. They all make up emerging markets. So once again, more volatile. That's why we don't have more of them in the portfolio. But for our younger clients, and particularly those in their 20s and 30s, as always, we do suggest having more in those small cap and emerging market areas, particularly for your super where you've got 30 plus years. Everyone should have some, but the amount depends on age and your plan. So we'll leave emerging markets there. And I want to talk a little bit about gold. Gold had a year that actually went backwards. So it's down 4% for the year, but it was spectacular. And you'll see from the long-term chart down the bottom here, from 2019, gold started to go up. And when COVID hit, it went up dramatically. And as the economy started to recover, gold pulled back a little bit. So I thought I'd talk about, we've had some questions, why do we have gold in the portfolio? And the key negative of gold is it doesn't produce income. So in the long term, my definition of investing is buying things that produce income. So if you're buying things that don't produce income, like artwork, like gold, like precious metals, like antiques, all these things are speculation because you're speculating that the price will go up. So you don't make any money unless the price goes up. Whereas for good quality shares, good quality property, when you invest in those, you receive income, rent and dividends. And that's my distinction between an investment. And the same with companies that don't produce income. They're the more speculative companies. You invest anticipating they're going to produce income. But if they're not producing dividends, then they're way more speculative. So why do we have gold in the portfolio? Partly it's insurance. Gold goes down when other things go up, and it goes up when other things go down. So it was nice to have it in the portfolio when markets were going down because we had some positive contribution from gold. It acts as a bit as a currency hedge. So, it's the go-to. If people think the US dollar is overvalued, they tend to buy gold. So it acts a little bit as a currency hedge. It acts as an inflation hedge. So if we thought inflation was ever going to come back, you'd see gold ramping up. We don't believe that at the moment, by the way, but it still acts as a hedge if inflation was to emerge suddenly. If we were to start to see some surprise inflation numbers, you would see gold spike. Now, we don't expect that to happen in the short term. It gives us a diversification benefit, which leads to a rebalancing benefit, which I'm going to talk about more in a minute and show you how we do that. But what that means is rebalancing is just when you bring the portfolio back to normal. So in our active portfolio, where we have, let me jump to the next slide. So our active portfolio has the top five bits in it here. So the ASX 200, the IOO, the 100 leaders, emerging markets, global small caps, and gold. Now, I show VTS here just to show the comparisons, but you'll see if you look at the 5-year returns, emerging markets, small caps, and gold all have a 10% return, but how they got there was very different. So the chart on the left shows the black line is global small caps, and the blue line is gold. So there's a time where gold was going through the roof and small caps were going the opposite direction. That gives us the chance to rebalance. So that means we sold a bit of gold and we bought a bit of small cap. Now, as that reversed, that means we're making money from that trade. So the discipline of rebalancing, we believe, and consistent academic research shows it adds value to portfolios, to diversified portfolios between 0.5% and 1%. So if we just maintained those holdings of small caps and gold over that 3-year window, they would have finished about the same. But we had the opportunity to rebalance at least 3 or 4 times from memory during that time. And each of those rebalancings made money because eventually these things revert back to the mean, and it also keeps the portfolio in balance. So that was partly why the active portfolio, which is a high growth portfolio, for the last year, it returned 7.29%. So the average high growth portfolio in Australia last year was 1%. So it's 6% above that, partly because of gold and partly because we took a profit out of IOO back in March. We did get back in after the Wuhan correction. If we'd waited a bit longer, we would have had a bigger profit, but unfortunately, our crystal ball wasn't working. It never does, by the way. But yeah, we were operating with a disciplined structure there. So it got a bit high. We took a little bit of profit when it turned. We got back in. So those things have caused that portfolio to add value. And over 5 years, it's been spectacular, 11% against other high growth portfolios that would be around 8%. So why wouldn't we put everything in a portfolio like this? And simply because it has the potential to have more volatility. So our core portfolios are the ones that give us more certainty in the long run, but this provides some downside hedging, which you all benefit from. So it's been a particularly good performer. We've just rebalanced, so you'll see around about now us buying a bit more gold and selling a bit of IJR. And that's because this 3-month window, it's actually now gone the other way. So this now gives us a chance to take some profits and buy some gold for when it goes back. Now, it doesn't always go back the same time, the same thing, but in the long run, all these little spreads amongst the components of the portfolio give us these rebalancing opportunities. It's a boring topic. It's not very exciting. You don't hear it talked about much, but it's critical of the discipline. And I always say rebalancing effectively pays for your fees. If it's done well, it sort of covers the fees of professional investing, or close enough. Hard to quantify exactly, but we see that in trades like this. So let's have a look at property. And property markets, these are all the capital cities. So while capital cities have had a good year, and look at Darwin, come back from the dead, literally. And for my friends in Darwin that have properties in Darwin, I know you've been waiting for this to try and get out of some of those positions. So it's a time where the market's starting to come back to life. There's a bit of activity, rents are going up. And that's led, and the Northern Territory's done pretty well through that. So Darwin's going through a recovery. Adelaide up 5%, Brisbane up 5%, Sydney up 4% last year, Canberra up 8%, Hobart up 7%. And we'll look at Heron Todd White's sort of position about where these different cities are in the market. But underneath this too is the fact that regional Australia, and that includes areas like the Sunshine Coast, but also regional Victoria, regional New South Wales, regional Queensland, are going gangbusters, particularly the areas reasonably close to the capital cities. And that's because of tree change, hill change, beach change, where people are wanting to be able to escape from the cities. Now, whether that's long-term persists, we will see. We have short memories, but it certainly looks like it's there for the moment. The Sunshine Coast, for instance, was up 15% last year. And there were some pockets on the coast that were up 20 to 30%. And they're areas that were lifestyle driven. So when we look at the National Property Clock from our friends at Heron Todd White, they've got most of the economy clustered in a rising market at the moment, because this is kind of a matter of fact. So we've seen some quick, we've seen all of a sudden areas that have come off a downturn, like Sydney and Melbourne, now be either, so they've got Sydney at the bottom of the market, they've got Melbourne is starting to rise, but they've got, look at all these regional areas that are rising markets: Rockhampton, Shepparton, Mackay, Mildura, Karratha. So it's driven by mostly regional markets, but also lifestyle markets in the bigger cities, Brisbane, Newcastle. It's interesting, they're calling the peak for Hobart. So for my friends who have property in Hobart and clients, it's interesting. Hobart's had a spectacular 3 or 4 years, and they're sort of saying that's probably at the peak. No one has a perfect crystal ball, but it's certainly a tougher buy in Tassie at the moment. As opposed to places like Brisbane and Perth, which are probably a safer buy at the moment. But as always, get good advice. Happy to talk to you all if you're in the market for investment property about where we think are the best risk-reward combinations at the moment. The unit market's similar, although the unit market tends to lag. So we're seeing more places at the start of the recovery rather than the rising market. Melbourne's still at the bottom of the market. Sydney's still falling. And talking to clients who've got properties in a city Sydney at the moment, they had to drop rents this year. So because of less immigration, but also people wanting to get away from those high-rise city apartment blocks. That will probably play out. No one knows how those social trends are going to play out. We often tend to have quick memories, so that if COVID clears in the next couple of years and we get on with life, you will see lots of people that do want to live in the cities and in those apartments. But you'll also hear people say maybe there's a trend here towards tree change, hill change, flight to the burbs where people can have their space. Only time will tell. And there'll be a bit of both things in there, in my opinion. So let me wrap that up, and thank you as always for listening. We do believe in a very disciplined process that reinforces our methodology, where we believe you should have an exciting life and boring money, and not the other way around. So we're not speculators, we're not action takers, we're not traders. We spend a huge amount of time studying and watching everything to keep our portfolios finely balanced for the long term, but to take advantage of some short-term opportunities. And yeah, goals, we do believe that all investing is best done as part of a real financial plan, one that has goals and strategies and a portfolio designed to meet those goals. And you'll hear us say that again and again, that all investing is best done as part of a plan. We take a long-term view because the short term is always unknowable and the long term is relatively predictable. We lean on the important factors of diversification, asset allocation, and having enough liquidity. And we know that 95% of active funds will underperform over the long run. So we use 70 to 80% index funds to capture the market growth. We do protect against short-term volatility with reserves and dollar cost averaging. So for our retired clients, that's keeping anywhere from 2 to 4 years worth of your future spending in short-term investments. And for our clients still building their wealth, that's dollar cost averaging. That's just investing every month. So this year, the dollar cost averages were the only ones that bought the bottom of the market. And that was the case for many of you, our clients. It was a good year for dollar cost averages. Dollar cost averaging in the Australian share market, the 12 months of investments for that would be up about between 15 to 20% for that year's investments. Rebalance regularly. It's the quiet achiever. It's the hidden thing that no one talks about because it's not very exciting, but it adds value over time that covers the cost of professional management. And as always, finishing with the 3 ways to lose money when you're investing in the market. Panic and selling. Congratulations. We had no one panic and sell this year. Having to sell, likewise. So that's because of those reserves, etc., and not being properly diversified. So yeah, well done for getting through 2020, what will go down as one of the craziest years in history. And let's look forward to 21 and hopefully a bit of life back in the place. I've got to say, for most of us in Australia, and certainly where we are on the Sunshine Coast, we've been very grateful to be stuck, in inverted commas, in such a great part of the world. So it was nice to celebrate Australia Day the other day, and just without going into any of the politics around that, just to be grateful for where we are. Thank you for listening as always. I look forward to talking to you all individually as we get through your reviews. And as always, yell out if you've got any questions, if you've got anything you want me to highlight in these things, always more than happy to. Have a great day. Talk soon.